Hey everyone, in today's video we're diving into one of the top setups in smart money concepts, the power of 3, also referred to as AMD. In this video, we'll cover what the power of 3 means, how to spot it on the charts, key guidelines and strategies for executing quality trades using this method, and we'll walk through several real market examples. If that sounds valuable, hit the like button to help us keep producing content like this, and if it's your first time here, be sure to subscribe to the channel. Catch you after the intro and disclaimer. Welcome back, let's jump right in. So, what exactly is the power of 3? It's a price action trading pattern that divides market behavior into 3 core stages: accumulation, manipulation, and distribution. The accumulation phase, as the term implies, represents a consolidation period where the market shows no defined trend. In this stage, price typically creates equal highs and lows, collecting liquidity and triggering stop losses placed around these zones. Based on the time frame, this segment can take on different structures. For instance, on a larger time frame, it may appear like this. The manipulation phase follows, characterized by a breakout attempt from the accumulation that doesn't hold, commonly called a fake out. So, in simple price action terms, what exactly is a fake out? It's a known concept that when price breaks beneath a support level, that same level often flips into resistance and drives price further down. This occurs due to the behavior of market players. When price revisits this zone, traders who previously bought there often use it as a chance to exit their trades near break-even. Simultaneously, traders who miss the initial drop may view this point as an ideal entry for short positions. This combined action typically causes the price to reject from that level. But if price doesn't reject and instead swiftly re-enters the prior consolidation zone, it's called a fake out. Fake outs are often among the most precise tools for forecasting price direction. A fake out reveals that the breakout lacked validity and was strategically used to capture liquidity below the range, luring breakout sellers. After smart money absorbs sufficient liquidity, the market tends to snap back in the opposite direction. This move is called the distribution phase. Distribution is where we look to execute our trades. As smart money traders, our goal is to enter after stop losses have been cleared. So essentially, the cycle goes accumulation, manipulation, and distribution. In a similar way, under a bearish condition, the market begins with a consolidation phase, then breaks out upward, targeting the liquidity resting above equal highs. If the price swiftly retreats back into the previous range, it indicates a fake out, and the power of 3 sequence completes with a strong downward move. So, how do we execute a trade using this setup? Our objective is to enter after the manipulation stage is validated. Initially, price needs to re-enter the range. This confirms the false breakout. We mark the candle closes at this point to define the consolidation zone. For entry confirmation, we look for a candle that breaks and closes back within the range box. A stop loss is placed just above the swing high, and our targets are key price levels ahead. There are moments when price moves aggressively and we miss the first move. When that happens, we wait for a new market structure to develop, then look for a retracement to enter with a solid risk to reward setup. In short, we focus on continuation entries during the distribution phase, aiming for further downside. Now, if you imagine this price sequence compressed into a daily chart, the daily candle would open, make a high, then drop to a low and close lower. Our main aim is to capture the most significant move within the intraday price action using the power of 3. With that, let's shift to the chart and walk through actual trade examples. Keep in mind that this trading setup isn't bound to any particular time frame. It works effectively across both lower and higher time frames. In this example, we're analyzing gold on the 30-minute chart. The market is forming a consolidation zone, with price getting rejected twice from each boundary. This signals that a range is in play and that liquidity is building up on either side of the structure. If our bias is bullish, we expect a sweep below these lows to trigger sell-side liquidity, followed by a potential upward move as the market distributes higher. On the flip side, if we have a bearish outlook, we anticipate a manipulation above these equal highs, preparing for a sell-off. Now let's break it down. Here, you'll notice 2 candles push above the prior highs, triggering buy-side liquidity and luring in breakout buyers who assume resistance has been broken. but as the price drops back within the consolidation zone, it confirms the manipulation phase. From here, we prepare to execute a short setup. In this situation, a short trade can be initiated at the close of this candle, anticipating a move lower. Our stop loss is positioned just above the swing high, and our take profit is set at 2 times the risk for this particular trade. And there it is, a clean distribution move confirming the power of 3 structure with a sharp drop in price. Now here's a critical point. Like every trading concept, the power of 3 works best when used in confluence with other smart money principles. For example, if a higher time frame supply zone was sitting at this same level, it would add another layer of validation for this entry. Why? Because the power of 3 setup would then align with a key level that has the strength to reject price downward. Or consider if the higher time frame trend was already bearish. Taking this short would offer much higher conviction since we'd be trading with the broader trend. That's why it's crucial to blend multiple trading ideas together to build more informed and reliable trading decisions. Now let's review another scenario. In this case, we're analyzing GBP, JPY on the 4-hour time frame. From a price action standpoint, the market had been trending downward for an extended period. However, it recently failed to print a new lower low, a signal that bearish strength is weakening. This shift was followed by a breakout above 2 notable supply zones, indicating that buying pressure is stepping in and a possible counter-trend move could be forming. Considering these developments, the directional bias on the higher time frame now leans bullish. Let's switch over to the 30-minute time frame to get a more detailed view. On the lower time frame, we observe the price establishing a consolidation zone, marked by 2 rejections from the upper boundary and 2 from the lower boundary. Liquidity is accumulating on both the buy side and sell side outside this structure. Once again, we are waiting for a liquidity grab and a fake breakout to validate the manipulation phase. Keep in mind, the higher time frame bias is bullish, as we discussed earlier. This suggests we want to witness a sweep below the equal lows, followed by a move upward. Let's see how this plays out. At this stage, price breaks beneath the consolidation area and retraces back to the previous support, which now acts as resistance and gets rejected. This rejection implies that sellers are attempting to drive the market back into the range. If they fail, it confirms that buyers are regaining control. With the manipulation now validated, we can plan a long entry at the close of this candle. In this case, we have clear signs of accumulation, manipulation, and distribution. This clearly shows how syncing a higher time frame trend bias with a lower time frame execution plan can help you catch a premium trade setup. And even if the initial long entry was missed, another opportunity could have been captured on the next bullish move. Also, if you glance at the 1-hour chart, you'll notice that the setup was equally favorable for a long position using the same power of 3 concept. This 1-hour order block served as yet another strong area to consider entering a trade. Remember, when evaluating a trading method, it's important to test its effectiveness across multiple asset classes, like currency pairs, stocks, and crypto. This will help you figure out whether it aligns with your strategy and suits your trading personality. A method that proves reliable on one instrument, such as a particular forex pair, might not yield the same results on others due to differences in volatility, liquidity, and market dynamics. Pay attention to how the strategy behaves across varying trading environments, timeframes, and market conditions, and make improvements based on those observations. When identifying the AMD phases, accumulation, manipulation, and distribution, on your chart, one important aspect to factor in is the role of different trading sessions. Each session carries unique volume characteristics, which can shape price action in specific ways. For instance, let's analyze the EUR/USD on the 15-minute chart. During the Asian session, price action typically slows down due to reduced trading volume for both the euro and the dollar. This often leads to tight range consolidation, without major volatility. However, this phase is crucial as it lays the foundation for upcoming price movements. Now, observe what happens when the London session kicks off. Price quickly spikes upward, sweeping liquidity above the consolidation zone and clearing the Asian session highs, only to pull back into the previous range. This is a classic sign of manipulation coinciding with the start of the London session when market participation and volatility increase. Eventually, price shifts in the opposite direction, distributing lower after the fake out. What you're seeing is the power of 3 pattern in action: consolidation during Asia, manipulation at London Open, and distribution to the downside. Recognizing how these phases align with different trading sessions gives you an edge in forecasting price direction and spotting prime setups. If you struggle to pinpoint consolidation zones on the chart, consider using the concept of equal highs and equal lows. Here's how. Start by determining your overall market bias. For a bullish setup, you'll want to find equal lows, which signal a buildup of liquidity beneath that level. Next, wait for a liquidity grab below that area. Once price climbs back inside the prior range, this confirms that the breakout was merely a trap, classic manipulation. Typically, this leads to a continuation move in the original trend direction. Now, let's talk about why this happens. In order for big moves to unfold, the market must first absorb enough liquidity. Institutions and large buyers can only enter if there are enough counterparties, meaning sellers. That's why manipulation is often necessary, to create the liquidity needed before the intended move can take place. So again, we identify our three key phases: accumulation, manipulation, and distribution. Our focus remains on catching the main leg of the move that occurs once manipulation is confirmed. And even if you miss the initial entry, don't stress. You can always wait for a pullback that offers a cleaner setup with a favorable risk-to-reward ratio. Just stay aware of key higher time frame levels, since they can act as turning points. Whether it's a supply or demand zone, whoever takes control will dictate the next directional move. That's where new trading opportunities emerge, aligning with our overall strategy. Just keep in mind, real-time trading is an entirely different experience compared to backtesting or demo accounts. Real money, real pressure, and real emotions are involved. The key to staying consistent is sticking to your trading plan. It's your roadmap to success. So if you found this breakdown helpful, hit that like button to show your support. And if you're new around here, consider subscribing for more trading insights. Catch you in the next video.